Go to the cloud. So good morning, everyone. Today is Saturday, December the 3rd. This is a Saturday with Eddie. It's a service that I provide. I think I want to call it a service now. It's an event that we all get together as traders. It doesn't matter where you're coming from, what program you're in, whether you're in my class or not. It doesn't really matter. It's for options trading. People who want to learn about options trading and interested in that kind of thing in the market. People who are more about making consistent weekly income. So we talk about strategies in options. We decipher the platforms. We decipher the trades. We look at all sorts of things. So this is basically an open forum. There's no penalty for asking questions. In fact, it's very, very highly encouraged. It's about the only way you're going to learn anyway. If you open your mouth, it means that you're learning. So we encourage that a lot. There's no damn question. If you don't ask the question, yeah, that's a problem, right? We can't figure out what you're thinking. So it's very interactive. You can interrupt me at any time. I actually enjoy being interrupted because I'm talking all the time. So it's okay to interrupt me and ask a question. Don't wait 30 minutes to get your question in. So I'm cool with that. Just find a nice breaking point and jump in. So with that, I think we have just one topic: vertical credit spreads. Are there any others? Anybody want to talk about something else? And I also want to get a feel for who's in the room, see where you are at, and see whether does vertical credit spreads make sense for everybody? So maybe we can use the chat and see who's already trading options. Let's start there. Calls and puts. Who's already trading calls and puts? Do we understand what they are? Okay. So it looks like few people. All right. Okay. Or maybe I should have asked it the other way. Is there anyone who's not comfortable with calls and puts? Because if you're not comfortable with calls and puts, then vertical credit spreads are just going to be a waste of time for you. So looks like everyone is comfortable with calls and puts. All right, that's the basic point. That's the basic starting point, I should say. So you understand calls. We'll fix that, Mr. And then I trade calls and puts. I haven't traded verticals. All right, that's a good spot to begin. So we're going to level set. We're going to figure out what's a good starting point for vertical spreads. The kind of spreads that we're going to talk about today are credit spreads, the ones that you get paid to get into the trade. So Dora is the same as Deborah. She says she trades. Really, Dora? I thought you were trading what they call spreads already. No?
No.
Oh.
I'm not in a hurry to learn that.
Yeah. Okay, that's cool. I'm good with that. There's no rush. In fact, when you are learning all of these, you want to narrow down the very, very basics before you head out into the bigger strategies, or more advanced strategies, I should say. So,
hey Eddie.
Yeah.
Before you get started, I have a question.
Okay. Yeah. Go ahead. Mm-hmm.
Okay, it's a burning question too.
Yeah.
You talk about the A+ trades.
Yeah.
A+, this is not a good trade. You work through certain examples.
Yeah.
What I'm finding is like the trades that move like the $10 or more, those are usually the more expensive ones. So what do people do when they have like a smaller account? They haven't built their account yet.
Yeah. So there are A+ trades for smaller accounts as well.
Okay.
And actually, there are probably more trades for smaller accounts when we talk about A+, because even when you have a big account, you want to trade as though you have a small account. Okay, so that's number one. We're talking risk management here. You don't want to be in the business of burning cash. And when you have a big account, we tend to kind of get ahead of ourselves and think that well, I've got a bit more free, more leeway, and so I can risk a little bit more. Well, that's the wrong attitude, I think. And I'm speaking from experience. When I was trading a large account, my head was so big, my ears were in different zip codes. So you have to, come down to earth and understand that the way to a lot of money is actually through small increments. So A+ trade, I have redefined A+ trades to where you're trading inside of a small account. Now, when I say small account, by the way, that let's also qualify small account. I call small account as $3,000 to $5,000.
Okay.
That's what I'm calling a small account. Anything below 3,000 is still a good size account, and you can still make a bit of money. I have actually got experience many times over with an account that I started off at $500. The objective being to see whether I can grow that account from 500 to something, bigger than that. And I have been successful many times over, starting off, with a small cash account of $500, trading options, no shares whatsoever. And the objective was to prove it out that I can go slowly from 500 to 10,000. Right?
Wow.
Yeah. So that's possible. It takes time. You just have to set the expectation correctly and decide that if you're trying to make $2,000 overnight, then maybe you're asking too much. Maybe I can give you a few addresses for some casinos in my city. You might have better luck there. What do you think? Walk with me here, Lauren. Walk with me here, Lauren. Yeah, but if you want to grow slowly, back in my country, we say if you want to go far, you go together, right? If you want to go fast, you go alone. So yeah.
So what companies though are we talking about? I mean, just maybe one example of something that's a smaller cap account. What would that be?
You mean what securities are you trading when you're talking about small account?
Yeah.
Okay.
Because I'm looking at SPY. I'm trying to narrow down my scope here so I can be more focused on one thing.
Yeah.
And I've been looking at SPY a lot, doing that in my sim a lot, and then also Visa and Target.
Okay. Well, let's take a look.
And also experimenting with SPX because I just wanted to see how that worked.
Yeah.
In its relationship to SPY.
Got it. So I'll start by saying that if you have a small account, you have no business working with SPX at this point.
Okay.
That's a nice way to burn your cash. If that's the objective, that's cool, but I don't think it is, right? So the reason I say that, obviously, SPX is a very, very fast mover. Second, it is expensive. So small account, for example, I'm just going to look over here at, what am I looking at here? Delete this gadget. What did I just do? Oh, delete, not detach. Okay, so SPX, let's see, even the least expensive ones just coming up in a couple of days, which will be 0 DTE at the money is about $1,100, right?
Right.
If you have a small account, you don't want to spend all of that because that's a significant amount. Remember, we talk about spending about 20 to 30% of your portfolio on one position, right?
Right.
So if 1,100 is not 20% of your portfolio, then you should stay away from this one. So let's compare that with SPY, which you mentioned. And SPY is more in your league, which is about $230. But then this is going to be 0 DTE on Monday, right?
Okay.
So this is not a good idea. Instead, what we prefer is to actually go out 45 to 90 days. Now, if you're trading SPY or SPX, you can probably go a little less than that, but everything else, you still need to go 45 to 90 days. But even if we pick a date like January 13, then you're back to that 1,100.
Right.
You're back to that 1,100. So let's see, what about 27 days. This is more in your league, right? But
Okay,
you're
that
saying
one's what? That one's 800.
857. So we talk about $900 commitment over here.
Okay.
Which is still a big chunk of your portfolio if you have a small account. But you want there's deeper strategy that we can go into, and I don't want to dive into that too much, but we can talk about it maybe in the later part of this session. But what you want to do, Lauren, is you want to join my tribe. That's what you want to do. So I'm going to use this opportunity here. Lauren, you want to join my tribe where I teach how do we grow a small account? How do we get from where we are, zero, $500 to 25,000, which is a huge target for a lot of people. A lot of people are trying to get to that 25, 30,000 because then they don't have to worry about PDT. You're familiar with PDT, Lauren?
Yes.
Yeah. So remember that PDT, and I want to talk about that in a whole focus program here for PDT. A lot of people think that with PDT, they, it's crippling, but it doesn't have to be. So I've developed something that you don't care about PDT and you don't have $25,000, and you're still making your $1,500 every week. Does that sound something like you'd be interested in?
Yes,
I think you would. I think a lot of people would. So that's in my class, and we'll talk about that later on in the program. But good question. A+ trades are actually designed for even small accounts. So yeah, we'll talk more about that. Sounds good?
Okay, sounds great.
All right, awesome. Thanks for that question.
Mm-hmm.
Any other burning questions? No other burning questions, huh?
I have a question,
Sure.
Coach Eddie.
Sure.
I wanted to know that right now, since the market has changed erratically, I feel like day to day, even week to week, it's so different.
Mhm.
And I know prior, you're the one who had me understand option, focusing on the delta. Which Greeks are now essential or important to look at when you're trading options?
So that depends on what strategy. So if you're doing straight calls and puts, delta is always important because we are always buying at the money. And we understand that at the money, delta is usually around 50. That concept does not change over time. That's number one. If you're doing, other advanced strategies that rely on delta being a particular point, for example, if you're doing a straddle, then again, for straddles, I'm also advocating for delta 50. For strangles, then you might go up to a delta 40 or a delta 30. But those are different strategies that we focus on a little bit differently for strangles and straddles. For most of you, I don't think that you're doing any of those. You're probably doing calls, puts, and credit spreads. I'm just looking at the faces or the names that I'm seeing here and knowing where you're coming from. Unless you have invested in another class somewhere else, I don't think you're doing that. But in terms of the Greeks that I pay attention to, delta is obviously very important for me because I don't buy calls and puts out of the money. They have to be at the money or slightly in the money. In fact, I'm notorious for going a little deeper in the money because I want results a little quicker. So let me throw this back at you, Stella. Here, what kind of strategies are you doing?
Mostly just singles right now.
Okay, then
triples, but singles mostly.
Okay, got it. So two things are your friend. Delta 50 is your friend, and also a longer DTE is your friend. Right. So let me explain what I just said on that. When I say longer DTE, I'm referring to what strikes that or what dates that you pick, what days to expiration. In case you're doing this for the first time and you're hearing that acronym for the first time, hopefully not. DTE is days to expiration. I'm saying this for the benefit of people who might be listening to this video later on. But days to expiration is that number that you pick or that date that you pick. The more time that you give yourself, the key advantage is that you're giving yourself time for that positioned to do its thing. It doesn't mean that you're going to, for instance, if you pick up a 41 DTE January 13, does not mean that you're going to be in that trade for 41 days, right? You can get in Monday and you're out Monday or Tuesday or something like that. But in case your thesis does not work out, you've got a few more days, you've got time to recover, right? So that's the advantage. Also, your theta does not decay as quickly as if you had a lesser time DTE. So if you had a 0 DTE, you basically have 6.5 hours to get it right, or go home, basically, right? With a 1 DTE, you're a little bit better, 7, maybe even better. So I would focus on further DTE. I would also focus on getting the direction correct, Stella. So here's what we can see based on the last, and I'm going to look at the S&P because that represents a broader section of the economy or the market. We can see we've been experiencing quite a few ups and downs, right? A few ups and downs. Is this a good thing, or is it a bad thing? Is that good or bad? Let me do a quick poll because I do have an opinion on it. Is the market swings, a wide market swings, a good thing or a bad thing? Where's my chat? Let me see what people are saying. Deborah says it's good. Stella, it's good. Okay. All right. There seems to be an ongoing consensus that that's good. And I agree. I wholly agree. When the market is moving up and down, even really wide swings, that's always a good thing. Why is that? Because we only make money when this thing is moving, right? That's about the only time that we're making money. If the market is moving flat, then there are other strategies for when the market is moving sideways, but we generally want that. So Stella, to come back to your question here about what delta, what Greeks I'm looking at, stay with stay with the delta 50, and if you're trading less expensive stock, then you can go out as far as you can afford. That's about the only disadvantage that I can think of. The further out you go, the more expensive that they become, but the better risk management that you have. Does that help, Stella?
It does. I've lately been doing out of the money. So I used to do at the money, deep in the money. So it helps.
Okay. How's that working for you? How's the out of the money working for you?
It's actually working.
What symbol?
Tesla and IWM.
Okay. So you buy out of the money and you buy 0. I mean, how many DTs are you getting?
Weekly.
Weekly.
So either 1 week, 2 weeks.
Is there a reason why you are going out of the money?
Because I get more of a return with out of the money, like multiples of like 5x, 10x.
I'm thinking you're going out of the money because it's a little cheaper.
That is true, but I also look at the option chain to see how it's multiplying too.
Okay. I wish I had a lot of time, but I think I can prove it to you mathematically that if you and I put in the same trade, you go in out of the money and I go in just at the money, I will probably progress a lot more. Not even probably, I am definitely sure I will progress a lot more. So I've done extensive testing, especially when it comes to leaps, where you buy a leap that is out of the money, say it has a delta of 30 or delta 30, delta 40, versus buying a delta 60 leap, and you have the same amount of time, you're going out maybe 200-300 days, and the at the money has always outperformed. In fact, you can enter a leap at delta 70 and you're out in 6 months. Whereas if you enter the same leap at delta 30, at 6 months, you're barely making breaking even or something like that. Eddie would make more money just because of his higher delta. That's true. When you have higher delta, you're basically making more money, and that's the reason that I think that a higher delta is better. But that's not the only reason a higher delta is better. The other reason that a higher delta is better is you are already in the money if you're going above 50, above delta 50, right? You also have intrinsic value. So let's look at some chains here, by the way. You know that everything that has that is out of the money has no intrinsic value and is going to decay to zero for sure. We understand that part. I'm going to add a few things here. I'm going to add, I'm going to customize here. I'm going to add intrinsic value. And I'm going to add extrinsic value. So this is not a lesson on the options chain. There's a different class for that. But notice that even at the money, or just slightly, just under the money here, this is the intrinsic column value, right? 0. Everything that is out of the money has a 0 intrinsic value. All it has is extrinsic value. What do we know about extrinsic value? Is that it is going to decay to 0. Intrinsic value does not decay. Right, let me say that one more time. Intrinsic value does not decay. What actually decays is extrinsic value. So if you're buying deep in the money, at least you've got some skin in the game, knowing that your intrinsic value is going to hold. So a downswing in your position means that you're holding on to the value of that contract for as long as your strike is in the money. Downstrike against you when you're out of the money, you're basically losing everything, even before the date of expiration has arrived. So add in other things like Vega and Gamma, and you're out of the money is toast. It's basically a bad idea. So I'm wholly convinced.
So even with this strike price right here for 195, as you can see, like it says 52 delta, right?
Yep.
This is why I tend to also look at the option chain, and it has 0 there in the intrinsic value. So if I'm looking for a delta that's 0.5, and I've dabbled, I've done deep in the money, at the money, and also out of the money and way out of money, just to see how it is. And I've just, for me, I would, if I was taking this trade and I was like buying a call, I may just do a 195 strike price or 200. I used to go way farther out, but I don't go as far out. So
okay, that's a huge difference. When you say it out of the money, I thought you were maybe talking about delta 20, 30 or something like that. But if it's just a few cents out of the money, what's a few cents between friends? You're okay, I think, right?
Okay.
Yeah, you're perfectly, you're fine. Just don't go out of the money here and go to the 220, for instance, right? That's just theta alone is just going to kill that within the first hour of the trading day if this does not move in your favor.
Okay, and also it also goes, in your stock too, right? And the movement of, because 220 is just so far out for even Tesla.
Absolutely.
Okay,
Absolutely.
thank you so much.
Sure, you're welcome. There's a use case for going out of the money, and that's usually not for straight calls and puts. So just to be clear, if this is something that you're learning and you think that when we go to spreads that we are not going to touch out of the money. In fact, today's topic, vertical spreads, we're actually going to be selling out of the money. There's a reason for that. So her question was very, very specific to straight calls and puts. Do you go out of the money? Do you go in the money? The consensus here is that at the money or slightly in the money is good. If she goes out of the money, then she's going probably 1 or 2 strikes. Looks like she's going with a delta 52, and that's actually not out of the money. Remember, when we talk about moneyness, when we're referring to calls, we're referring to the strike being less than the current price. So the current price being 194, anything below 194 is what is considered at or in the money. So any strike below 194, and that's why on the options chain, 195, even though that's only 14 cents away from 194.86, that's why on the chart you can see that it is out of the money. Does that make sense? So everything, when you're buying a call, you want to make sure the strike price is below your current price, right? That's number one. And then the delta is at least 50. So good question over there, Stella. That brought out a few refresher points. I like that. I like that. All right, let's get this ball rolling now. Hopefully we don't have any other major questions. So, but they're welcome. They're welcome. So when we talk about credit spreads, vertical credit spreads, they go by many names. You can call them credit spreads. You can call them bear spreads. Different platforms call them different things. But essentially, when we're talking about spreads, credit spreads in particular, we are trying to take advantage of that situation where we don't exactly know where the price is going, right? We don't know exactly where the price is going, but we know where the price is not going to go. That's the key differentiator. That's the main, that's the whole thesis. The whole thesis that you know where the price is not going to go, right? I think most people are in that category, right? Can we say that? Or we can fairly, assume that we can tell much better where price is not going to go as opposed to where it's going to go. That's the thesis. So with that said, let's draw a few lines here on this board. So I'm going to use the price level tool. Current price here is 407,170, which is where it closed, right? So I'm just going to edit properties. By the way, if you're watching this for the first time or the upteenth time, I am using a fancy program over here called Thinkorswim. Yeah, Thinkorswim. That's one of my favorite programs. Actually, yeah, it's one of my favorite brokerage platforms. I like it. So let's think in terms of let's draw a few scenarios. There are two possibilities. Any given day, there's always going to be two possibilities. Price of the underlying is going to be moving upwards or it's going to be moving downwards, right? That's basically what it is. Or it's going to be moving sideways, but it's going to move somewhere, right? So with credit spreads, our thesis is that maybe price is going to go upwards, right? Let's paint two scenarios here. If we think that price is going to be trending upwards, then how do we take advantage of that situation? How do we take advantage of price going? What's the simplest strategy using options that you can take advantage of a security when price is going up? Go ahead and put that in the chat. What's the simplest options strategy that you can take advantage of when price is going up? Okay, it's a call. All right, two answers. That's correct. So you can buy a call, right? A call is it's a simple strategy that you can do. It's the simplest strategy, right? Just go to the options chain, go to the trade over here, and let's see if we follow our teaching here and say that we're going to go 20 days out. A call would cost us roughly what? $7,200.40, right? Right, $7,240. That's an expensive proposition right there. So most people, when they're doing calls and puts on SPX, they're probably going 0 DTE at the money. They're probably spending about $1,100 to maybe $2,000, sometimes even $3,000 these days, especially when the VIX is a little higher. But all things considered, you'd be spending at least $1,000, give or take. Okay. We see a few more answers here. Somebody says buy a call. Somebody says sell a PCS. That's also correct. So that's where we're going. We're going towards selling a PCS. But you can see that this is already expensive. This is $1,100. And that's cool. So the next thing that we would do is kind of estimate where do we think price is going to go. And based on the daily chart, right now, the support, or rather the resistance level is right about 4,100. So you've got about 30 points, give or take. Okay, about 30 points, give or take. Is that enough? Do we know that it's going to get there? I don't know, right? We have no idea. But the proposition here is that even if you were to adjust your probability of success here by about 50, 60%, you're looking for maybe 10 or so points. So it's a good deal, but it's expensive. So that's one way that we can do that. The other way is we could sell a strike below 4071 where we think that price is not going to go. So let's talk about how do we determine how price is not going to go there. First off, by the way, when you're doing a credit spread, this is not something you do before the market opens. You want to do this when the market is open. And if you're doing it on SPX, it's the only place I suggest you do it, SPX, NDX, or DJX, any index or RUT, the Russell 2000 index. You don't want to do this on an equity because of the risk of assignment or pin risk. So let's figure out, if the market were open, where do we think that this would go? And if it's trending upwards, what is that safe distance that we can choose our strikes on, right, for PCS? A PCS is a bullish strategy, by the way, right? It's bullish. Even though it has the word put, when you combine it with credit, it becomes a bullish strategy, right? Bullish means that you're expecting price to trend above a certain area or just move up. So let's go over to the options chain. Since this is a 0 DTE day, we're going to decipher some things. First off, I'm going to look at my watch list. On my watch list, you notice that on this last column, I've got ATR, average true range. So over the last 14 days, that's what this represents, that metric, SPX has averaged about 53 points moves. Now we know it could move less or it could move more. Just on Thursday, it moved 122 points. So this number obviously represents, some outliers. It represents some lowliers. I guess that's the opposite, and somewhere in between. But it's an average over 14 days. That's a simple moving average. No, it's not the simple moving. It's the simple average true range. I don't want to confuse SMA with all this. That's different. So $53. So could we safely say that when the price of SPX is 4071, I'll pull out my calculator here, that it could potentially move to 4124 on the upside? So even though I don't see your faces, I'm guessing that your heads are nodding. Yes, right. On the other hand, it could move 4071 minus 53. Could it also go to 4018? That answer again should be yes. So this is one metric that we can use to guide us in what are the possibilities of S&P 500. Where could it go from where it is? What are the possibilities? So it could go as low as 4018, and it could go up as far as 4124 on average. That's not set in stone. That's what that number is saying, because it's a plus or minus. That's one metric. Metric number two is that most programs will tell you what the implied volatility is, not to be confused with the VIX, which is a volatility index, but the implied volatility is different. So on your Thinkorswim, you notice we have plus or minus 29 point something, right? 29 and change. Let me maximize this guy. $29. That's also telling us that on this particular given day, December 5 contracts, we're expecting the price of S&P to move roughly up 29 or down 29, somewhere in between there. So that's another metric that we could use. So which one should we use, the IV or the ATR, or a combination of both? I think a combination of both. But that's not the only thing. We can also go back to the chart and see where has it moved in the recent past. So for that, we have to, break down. I'm still on the daily, and I'm going to, suggest that maybe 4025 is an area that I want to be below if I'm going to sell a CCS, right? I'm going to go, by the way, to the 15-minute chart just to see a few more things here. A couple of things I want to check on. I went down to the 15-minute chart so that I can see if there are any gaps that I need to fill. And I want to be on the other side of the gap. I love gaps, by the way. Gaps on SPX. Gaps on anything else, I'm not too sure. But gaps on SPX, I think we've developed a really good science for how to trade those gaps. So right now, I don't see any significant gaps. This gap has been filled from Friday, obviously. And if there's not much significance down there. So Cloud, what do you think? If I sell a 40.30 and buy a 40.25, would that be a safe area?
According to the daily moving average on that expiration date and SPX moving average, it would be safe. But for my comfort, I'd like to see if I can get something a little bit less.
A little further out, you mean?
Yeah, further out.
A little further out. So that's a good summation, because by our calculation, we actually saw that maybe the safer area would be the 4018, and because we don't have a 4018 strike, maybe the 4020, give or take, right? Mm-hmm. So the things that we're going to actually see determine what direction we go are, first off, what is the price? What is the premium that we can get? So let me give you just before we get there, let me describe the semantics of a credit spread, since we just talked about strategy here. But so for credit spreads, the idea here is that you're selling premium. You're getting paid. You're selling a strike closer to the current price. The leg that you sell, the short leg, is the one that's going to be closer to the current price. And the one that you buy, that's your insurance leg, is going to be farther away from the current price. And the reason we do that is because we can't buy anything naked, right? Sorry, we can't sell naked. We can buy naked. We don't want to sell naked. Not that you cannot, you can, but you'd require some extreme privileges. Some people have them, and it's generally a bad idea. I think the industry does agree on that it's a bad idea to have or to sell naked unless your name is JP Morgan or something like that. You don't want to do that. Let me delete this line so that it stops confusing me. So what we're going to do is we're going to follow Cloud and see, is there any premium over here? Can we sell anything at 40.20? So mind you that the market is closed, so we don't really know. By the way, let me clean up my options chain here. And also go from spread single to spread vertical. So we're looking for anything below 4020. And since I'm not showing enough strikes, I'm going to increase this to about 30. That gives me more strikes. Did you see how I did that? You just simply type in a number there and it will give you more strikes. I've seen a lot of people do all. That's not efficient at all. You're making your program work too hard for you. It has to pull all that data. Don't do that. So just do 30. That is a great number. Okay. So we're looking for the 40.20, 40.15. And at the moment, that is going to give you 60 cents in premium. Is that good premium these days? Probably not. Right? 40.15, 40.20, 40.15 is going to give you 60 cents in premium. I mean, you could think it's good. It's okay, right? But it's not great. It's not great. These days, you want to go for a premium that is at least $1, $1.10, $1.15, $1.20. So 60 cents is not great. And the reason I say it's not great is because that's where we want to be getting out. That's where we want to be getting out of our CCS or our PCS. Previously, we have discussed that whatever premium that you get, you're trying to buy it back at around 10 or 20 cents. That has become more difficult. So because the premiums have been extremely high, or they have been, well, not extremely, but they've been high, then what we do is set a profit target. So I like to set a profit target of about 70 cents or 80 cents, give or take. So if I buy something at, say, 150, right? $1.50, then I'm trying to get out at roughly 80 cents. Does that make sense? If you sell something at 150 and you're trying to make 70 cents, then the right thing would be to sell it at about 80 cents, right? Did I do that math right? No, 1.5 minus 0.7. Yeah, the math is right. Yeah. So it means that when we see a credit here of 60 cents, that's way too low. Let's look at the 30. 30 is giving us 70. All right, we're starting to make some money here. 40.45 to 40.50 is when we get $1.30. Well, let's go 40.40 to 40.35, $1.15. Let's look at this number that is closer here. This is the one that we're selling, the 40.40, which is right about here. And let's also do some math here. The difference between 4040 and 4071 is about 31 points. You're borderline. You're very, you're too close to the fire, right? This is too close because a downswing of about 30 points, which is not uncommon, will take you out. So I'm with you there. I would probably go to the 30 and not the 40 and take less money, right? 35, I'd go for the 70 cents, but I wouldn't accept the 70 cents. I'd probably set this for $1.10. Here's how you get $1.10. The way you get $1.10 on that, or even more than that, is you sell as the price moves temporarily down. If your thesis is still that price is going to go upwards, then you sell your PCS when the price is going down towards you. What do we know about a credit spread or any spread and the relationship with the underlying price, right? We know that the value of the spread increases as price moves towards it. So if we're going to sell something that is here 40.30 or 40.35, give or take, we know that as price moves towards that spread, then the value of that spread is going to be increasing. Yes? Hopefully we all understand that, right? And that's when you get it. So we're looking for the low of the day, LOD. Anybody familiar with LOD? Right? No, nobody knows what LOD is, low of the day. There's nothing scientific about that. It's just where the lowest price recorded for that day is. So you're not necessarily waiting for the low of the day to hit, because if you're waiting, the premium is going to basically dry up and you're out. So what you want to do is you want to buy, or you want to sell these when we think that we have stopped going down sufficiently and it's about to turn around and go up. So there's a little bit of nothing, I guess, guessing or something like that. But your thesis should be that the market is heading upwards. Okay. So we'd sell the 40.35 and buy the 40.30. That's basically the thesis. You would make money if price remains well above 40.35, and at the end of the day, price closes above 40.35. With credit spreads, the way that I teach it, the way that I recommend is that you don't wait until the end of the day. Instead, what you do is that you wait until the spread has decayed sufficiently, met your target, and then you buy to close. Remember, to open the trade, we had to sell to open. To get out of the trade, we have to buy to close. Is that right? That should be a big yes. So she's asking, a retracement is what you are anticipating, correct? So a retracement here would be, price moving downwards. But that, the exercise that we're doing right now, the example we're doing is if we anticipate that the price was going to go upwards, then that's what we would do, right? So the other example that we want to do is, what if we thought that price was going to go down instead of up? If price was going to go down instead of up, that was our thesis, then we'd be looking at CCS, call credit spread. So even if it has the word call, it's a bearish strategy. When do you know when the spread has decayed significantly? When you close to the, you know that the price has decayed sufficiently when you look at your P&L or you look at your monitor screen. And you know, here's what we're going to do. I'm going to bring up on demand and let's see whether we can actually do see whether we can actually do a spread. Right, well, that's baking. I'm just bringing up, right now I'm logged into my SIM account and I want to log into on demand. In order for me to log into on demand, I actually have to bring up live. So here we go. This is the live and on demand. And let's switch to 2022. We're in the month of December, right? Let's go with a day like, I don't know, pick any day here. And does everybody know how to do this, by the way? You all know how to do these on-demand stuff? No? Joy knows. The Queen Latonia does not know how to do it. Yes, YouTube taught me. Good, 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 good. Yep. So to get to on-demand, you first have to log into your live account. And then once you get into the live account, then there's this, it says on-demand. Yeah, it's as simple as that, on-demand. And on-demand is a feature of Thinkorswim that allows you to replay the market at a particular point of time. So it's as simple as that. So let's simulate that. What happened on this day, November 28? Do we know what happened on November 28? Anybody remember that was what day of the week was that? Monday, November 28. I don't remember what happened. Man, Monday's so far away. The market went down. So the market went up on the 28th. Oh, okay. Well, let's see what's happening here. So it's we've got about 48 seconds to, or 10 seconds the market open here. So we're going to see how we can do this. First off, we understand ES is right about down, so 30 points on this particular date. It looks like the market actually went down, I think. So if we're going to do a credit spread, we should, our thesis should be a call credit spread. The reason being that we gapped down. Now, S&P does have a tendency of, once it gaps down, it comes back up. But let's do a real quick spread here. I'm going to go to the 15 minutes so that we can see this drama a little bit more. So price is moving downwards. Do we know what this gap is going to feel? I don't know. But if I were to pick a spread, first off, I'd go here to the chain, look at my 0 DTE. Okay. And see what the implied volatility here. So on demand does not give us that data, it looks like. So let me see if there's any other way of doing this. You guys are too quiet, by the way. What's up with that? Okay. Right, let's go with the 40-40. So the price seems to be going upwards here. So that's the time to do to sell our CCS. So I'm going to pick maybe the 30 because this is above the gap. Let's see how that works for us. I'm going to choose spread vertical. I'm going to be on this particular side. So 30, 35 right now trading at 60 cents, not great. Let's try the 20, 25, 30. All right, I'm going to lock it in for about $1. How about that? And I'm going to do 5. Let's also talk about how much does it cost to got filled at $1. That's great. So how much does it cost to do a credit spread? The width of the spread is a concept that you should already know. When you have two legs, let's see if I can get some background noise out of the way here. Somebody's got an open mic. Who's got an open mic?
Marsha.
All right, Marsha, we are going to fix something here for you. All right, Marsha, I'm going to mute you here for a second. Unless you have a really good song you want to sing to us. Right, there we go. Cool. So we're in the spread. By the way, if we got in for $1, maybe we got in too low. Let's see what's happening here because price is moving towards us. Do you see that's one danger of selling too soon. But either way, we're fine because it's at 30 and our thesis here is that price is going to eventually trend away from us. So how do we, the question on the floor was, how do you know? I'm sharing my screen. Am I not sharing my screen, Antonia?
Yeah, we see your screen.
Okay, so Antonia, it must be a problem on your end on that. So how do we tell what's happening with this spread? So we can go to the monitor section, and we can look at S&P here, and we see that we are up or down, however much. We can add a few more columns here, like PL day, PL open. PL open is already there. So PL day is what we just added. I don't want to see 2 PL opens. Just one is good enough. And how do I know the price, the value of my spread? Well, I can always expand these, and we can see that some very confusing math over here. You have to do the math to figure it out, but there's an easier way that I'm going to show you here in a second. First off, I'm going to go to my field orders and see that I have got a $1 credit, right? And in order for me to make money, I have to buy these less than I bought it. Does that make sense? So I sold it for less than I sold it. I sold it for $1. In order for me to make money, I have to buy it for less than $1. So I'm going to put a closing order, right? I'm going to put a closing order, and I'm also going to put in a stop loss. Somebody asked me the other day, can you set up a bracket order after you have entered your trade? Now, remember, we entered here without a bracket order. So the question is, can we put in a stop loss as well as a take profit? Then the answer is yes. So here's how we do it. In my position statement, I am going to right click on the symbol itself and create a closing order. Step 1. Step 2, I'm going to perform the action that I need as though I'm actually going to close it right now. So which is to buy the vertical. Right now it's at 150. So I'm not going to do that just yet. Instead, what I will do is I will make this into a OCO order. So this is currently a single order. going to change that to OCO. You do this after you've already entered the trade if you're trying to create this into a bracket. So once I do that, then I'm going to create an opposite order for this, a duplicate order. And I'm going to manipulate a few things. This is my take profit. So I do want to take profit at, say, 0.20. And this is going to be my stop loss. I'm going to change that to stop. And let's do some discussion here. If I sold this for $1, right? Let's see who I can pick on here. Who's been doing spreads for a while? Been doing spreads for a while. Anybody been doing spreads for a while? No one's been doing spreads for a while. So I'm just going to pick somebody here. Mary, what do you think? If I sell this for $1 and I want to protect myself, should my stop loss be less than $1 or more than $1? Or anybody who wants to answer that question. Should be more, right? Cloud says it should be more. So how much more is the question? We're going to go with a 1x. So a 1x stop loss would be $2, right? If we receive credit of $1, then our stop loss should be $2. So I'm going to put in $2, and it looks like we're pretty close to being stopped out because right now the price is that. Here's what we're doing. We're setting up a bracket order after the fact. After the fact means that we already put in the order. It's live, but we did not put in a take profit and we did not put in a stop loss. So we're going in and adjusting to put in both. Confirm and send, and go ahead and send that. So now in my monitor, I should have my bracket. Do you see how that worked? It's like magic, isn't it? Stop loss at 2.5x or less. No, stop loss at 1x. Faye, 1x. 1x, not 2.5x. So for my 1x, yes, that is correct. That is absolutely correct. I don't risk 2.5 times. Never. It's always going to be 1x. You can risk 2x. Some people even go 3x. I call that bad risk management. It could be true. That is true, Cheryl, and that is why you have to pick that direction first and foremost correct. So I'm responding here to Cheryl's question. She says that SPX moves so fast it stops you out easily at 1x, right? What did we do today? We entered too early in the trade before we had all the information that we needed, right? So if you enter too early in the trade, you're likely to be stopped out. So there's also timing involved. We have to make sure that we understand what direction is the market going. Are we sure? Yes. Or we're relatively sure, I should say. And then if it's yes, then at that time we enter the trade. If we enter too soon, we run the risk of getting paid or really poor premium. For instance, we got premium at $1, right? We got premium of $1. Right now it's trading at 135. Does 35 cents make a big difference? Yes, it does, because your stop loss is at 2, and that's only 50 cents away from being stopped out. So you want to wait so that you can get the best premium possible, and then you can put your 1x. Why 1x? Because the risk on a credit spread is so lopsided. On this 5-point wide spread, and I got in 5, think about how much I would potentially lose, right? So my risk of 1x is 100 times 5 contracts, that's $500. If I went to 2.5x, that would be $2,500. Not good. Is that right? Because I'd be losing 250. I'd be losing 250 times 5, $1,250. So no, that's way too much to lose in one day. I'd rather not do it. So 1x for me is what I recommend. So whatever premium that you receive, you multiply by 2, that is called 1x. Let me pause here for questions. So far, the trade is doing good. Before you ask your questions, let me clarify. I think I forgot who had asked the question. Was it somebody who had asked the question? How do you know what your premium is after you enter the trade? This is how you know. You look at the mark. If you're on Thinkorswim, it will tell you what it's trading at. Remember, we got filled. If you look at your field orders, we got filled at $1. That's your net price. And to know how much it's trading at, then you look here, it's now trading at $1.20. So 1 minus 20, 120 is 0.2 cents. We are down roughly about $100 on 5 contracts. Pause there for questions. Latoya, can you clarify what you were saying earlier when you say we want to be on the other side of the gap? Yes. When you're choosing the strikes that, for this particular credit spread, this is the gap that got created in the morning on this particular day. With me so far? So on this particular day, when SPX opened in the morning at 9:30, it gapped down. When you're selecting where to sell your spread, you want to be on the other side, meaning above this area. Let me see if I can draw that. You want to be above this area. Does that make sense, Latoya?
Yes, thank you.
Yeah, you don't want to be in these. And the reason you don't want to be in this particular area here is because SPX has a tendency to want to cover that gap. And so you're risking if you're inside that area. We know that based on a lot of statistics, it usually comes back up, tries to cover the gap, covers the gap maybe, and then either retraces, goes back down, or in some rare cases just keeps going up. Well, it's actually not rare, but you certainly want to be on the other side of this of the gap that is created. Does that help?
Yes, thank you so much.
Sure. No other questions? All right, cool. So let's see how this trade is going. I'm going to go back to the monitor. We're still down about $100.
I have a question, Eddie.
Yeah, sure.
So we can look at the working order to see how price is moving.
Yep.
Whether we're losing or gaining. How does that translate to the chart itself? We know that the chart should be going up if you're gaining.
So this is the chart, and you're trying to figure out to know whether you're gaining or losing based on looking at the chart. Is that your question?
I'm looking at the working order and I'm seeing that it's moving.
Yeah.
But I don't know how to put both of them together, the chart and the working order movement, those two things.
Yeah.
So is the chart moving by $1 every time the working order moves by 10 cents? What's the correlation? How much is what moving?
So the chart is it's just a visualization of what's happening in general for the underlying price-wise.
Right.
Remember, the price that is moving up and down here is not the premium. What's moving up and down here is the price of the underlying. So S&P right now trading at 4008 is what we're seeing up here as it goes up and down. These bubbles that you're seeing are your orders. So this is my buy. This is my this is where I bought. This is I believe this is my stop, right? No, my stop is no. This is my stop. This is my sorry. This is my stop. This is my take profit. It's a stop, STP. If you wanted to look at the price of your premium on the chart, then there's a way to do that. The way to do that would be to actually go out to your options chain. Let's see whether I can simulate that. And I am going to send these to the chart. This is what we sold. I'm going to right click and I'm going to send these to maybe my chart, which is currently blue. So if I go to my chart here, and I'm waiting for data. Hello?
Mm-hmm.
I'm waiting for data. Pretty sure my call will be answered in the order it was received. He's got a good joke for us in the meantime. Right. Could be an on-demand thing. I don't know. Not too sure. But if this were live, I would be seeing a chart of that spread.
Mm-hmm.
Okay. I'd be looking at a chart of that spread. Hopefully it comes out. Let's try something different. Let's go with, oh boy, is my internet even good today? I think I broke my system.
Oh dear. I'm sorry.
That's all right. Well, let's go to my other. Luckily, I've got two systems going here. Let us go to simulated trading and see whether we can simulate that. If you wanted to see the chart for a particular option that you're inside, that you're in, you can do the same thing that we just did, which is right click on that particular options. Let's see, I wanted to see, let's say I wanted to see a graphical representation of this particular spread, the 4085, 4090, then I can right click, send this maybe to my chart. Let's try the same thing. And not working. Okay, that's cool. We'll make it work. Ah, there we go. Yeah, this is it. So I'm looking at the chart for this particular spread. So we can see that it's trading at 153 and going up and down. This is the daily chart. Oh, sorry, this is a 15-minute chart. But I can also see on a daily chart how it has moved in the past. Might not be very useful for me if I'm not, because we don't look at particular spreads or strikes. We look at the whole thing holistically, right?
Okay.
So that might not be a great example, but if you really wanted to, I'm just answering your question here of how you wanted to see your price on a chart, this is how you would do that. Okay. If you wanted to see the price on a different one, I'm going to push SPX here, and you wanted to see your spread, or rather the chart on a particular symbol, on a particular options strike, then you would do the same thing. I'm going to send this one over here to blue and go to charts. Yeah, this is what I was expecting. So it looks like it might be an on-demand issue where I cannot really see my chart. But if you wanted to interrogate your particular position more in depth, have an in-depth understanding of where your contract is moving, this is where to go. Generally, this is a very confusing thing, especially if you're trading and it's live. The better way is to simply stick to the monitor tab, occasionally glance there and you can look at your position that way. Does that make sense?
What happened to me the other day? I was practicing and I sold at 110 and I wanted to come out early, say 80 cents. And it took me out with hardly any profit.
So you probably tried to sell at market or something like that, or buy at market.
It was at limit, but I was wondering if price probably had moved beyond that point, why it took me out immediately.
At such a bad price?
Yeah.
Without seeing the trade itself, I don't know how it worked. But let's try and simulate what you're saying, right? Luckily, we have a trade over here. It's currently at 105, so we're just down $25, so 30 something dollars. And we want to demonstrate, how do we get out of this trade? How do we make adjustments? So still over here in the monitor tab, you can make adjustment to two things, right? Either your stop loss or your take profit.
Right.
Say we decide that, it's going to be really tough to get 20 cents today. What we could do, maybe say, all right, maybe I just want 50 cents today, right?
Right.
So I'm going to bump these up from 20 cents to 50 cents. All I have to do is just do a right click on these, do a cancel replace, and adjust the price. I'm going to make these 50 cents. Okay. So I'm still taking advantage of my bracket order here. And notice that now my target, my limit is 50 cents. That's one way to do it. Okay. Another way to do it would obviously be to come over here, right click, and just create a closing order and go for whatever price. If you did that, you're going to receive a warning that you're opening up a new position. So again, that's the bad way to do it. So the better way to do it is inside of your bracket order. That's where you want to manipulate. Never ever try to sell one leg at a time. That is not good. No bueno.
Okay, thank you.
You don't want to go one leg at a time. You want to always manipulate the spread as a single unit. So I think this is still a good trade. I mean, we are only about $75 off, has not hit our threshold of $2. Likely chance that as time continues, it's going to decay. So that's the hope here. Might actually speed it up a little bit. Let's see. Well, we could do that, or just understand what's actually going to happen. Is that a good example? Does that help people who have not seen a spread before? Does that help? Cloud, this was your question. Is this helpful?
Yes, yeah. One thing I want to, I guess, get your opinion on. In this example, this would be considered a day trade, right?
It is a day trade, yes.
Okay, so if we're trying to avoid a day trade, and what strategy would you suggest? Because at the end of the day, we just let it expire. So if our goal is to let it expire, what would that make a difference in the in your strike you're choosing?
The strikes that I choose are based on where can I get the most premium and where do I think price is not going to go. The choice to let it expire worthless is, for me, I found it to be a very tough choice. The reason is that SPX generally tends to fluctuate way up and down. And so it's either going to take you out, or you're going to see profit at some point, and then that profit is going to go away, right? And then maybe it might come back, it might not. So my way of risk management and for managing that trade is to see profit, take profit. So basically I'm saying that once I hit my profit target of 70 cents per spread on a credit spread, then I'm good to go. It means that I'm going to use up a day trade for me if I'm in a PDT situation. I'm taking risk off the table, which to me is more important than anything else. You with me on that, Claude?
Yes. Okay.
So when you choose to let a spread expire out of the money, because we did sell these out of the money, and best case scenario is for it to expire out of the money, which means that we don't have to buy it back. That's what that basically means. However, the risk is so great with S&P that you don't want to be in the business of, biting your nails all the way until 4 o'clock in the afternoon. And even then, you might just be in that situation where you're 1 point off, and then the closing price, there's an adjustment by 1 penny or 2 pennies, and all of a sudden you're in the money. Okay.
Okay.
So if you're going to do credit spreads, I know the answer most people probably want to hear is do 1 DTE or something like that. But with SPX, the movements are almost unpredictable. So it's gone are the days when you used to be able to do 7 DTE or even 2 DTE, anticipating price movement in a particular way. And then the next morning you'd just be buying to close, in which case PDT would not be a problem. Yeah.
Right.
So, yeah, for me, I prefer to, there are other better strategies for 0 DTE or for swing trades. For swing trades than credit spreads. Let's take a look at this guy. This guy is now at 80 cents. So we are up $100, right? And remember, we adjusted our profit to 50 cents. So we're just looking for about 30 more cents here to make some money. So a little bit of a push down, if I go to the chart, a little bit of a push down will net us that where we want to be. And I forget who had asked the question here about what if you wanted to take profit. No, I think I answered that question. So hopefully this is helpful for people watching these. Does the 1x make sense now? 1x stop loss? Hopefully it does. Hopefully it does. So. All right. Let's see what are the questions. What are my thoughts on 5 and 10 point spreads? I favor 5-point wide spreads. That's what I tell everybody. You can do 10-point wide spreads, but you're increasing your risk. So you should get a lot more premium with 10 point, but you're also increasing your risk. So as long as you have good risk management, either one of those is fine. 5 is the more common one. It's the one by default. You don't have to make any adjustments on the platform. That's what I would go for. There's a particular use case for 10-point spreads or even greater point spreads, specifically when you're doing maybe a fly, an iron fly or a butterfly. Then you'd go a little wider on the spreads, 20, 30, sometimes even 50 points to capture more premium. But that's more advanced than we want to talk about here today. And is that to what? I'm not sure I understand your second question there. So, all right, what about the PDT hack selling on both sides, CCS and PCS at the same time? There is a way to close this spread with a PDT hack. I know how to do that. I don't teach it. I don't recommend it. It's a hack. It does work. I've tried it. I've tested it. What do I think of it? It's a bunch of BS. Yeah, that's my opinion. Purely an opinion. Purely an opinion. But it does work. Yeah. Yeah. Learn to trade properly. It's a bad trading plan. That's not good. Why? What is the downside of the hack? Only one broker supports it. I don't know any other broker that supports that PDT hack. And what she's talking about is, well, no, I'm not even going to go show you how to do that. But only Thinkorswim, as far as I know at the moment, supports that, which means that across the industry, that has not been proven out. Maybe when FINRA catches up to it, they're going to close that hole. So, and if you don't do it correctly, you are exposing yourself to now 2 PDTs instead of just 1. So don't do it. She says she has used it in TradeStation, but there was a fee. not sure what the fee is. Probably the fee was the exercise. I don't do TradeStation, so. All right, cool. Any other questions on credit spreads?
Eddie, I had a question. If you remember, you showed an example from January 6th when you made about $90,000 on a trade in one day. If you remember, was that buying a put on that day?
I think I remember those were puts. Yeah, those were straight puts. Yep.
Okay.
Mm-hmm. Yep. Those were not spreads. So
was that a 0 DTE?
Yep, it was 0 DTE.
Okay, thanks.
Yeah. Those days, there've actually been a few of those days in the year. Last couple months, we saw some really good moves, I believe, that S&P gave us. But of course, it's in hindsight. Let me bring up TradingView here. I think yesterday was a good day. This was a good day as well. A few days, I'm trading futures these days also. So if you're on the correct side, on the right side of a movement like this one, say you bought a futures contract, you wake up in the morning and it's beautiful. It's beautiful. The other day, I think don't remember whether this was it. It was a put. Yeah, it must have been this one where we just dropped significantly. And again, I didn't expect that huge of a drop, but it did drop. And right at the bell in the morning when the market opened, shut down. I saw the profit. I took it and I was done for the day. 9:31 from an overnight trade I had placed around midnight. So the good thing with futures is you can trade them overnight, so. But to your point there, Cloud, those $90,000 days are very, very elusive. And we don't know. You just don't know when the market is going to behave like that. Okay.
I have another question, Eddie.
Yes, ma'am.
Earlier you said go for premiums at 120 and come out 50 cents down instead of, even earlier you said 60 cents and come out at 20 cents or 10 cents. Would that have anything to do with the VIX? Why would you say that?
Okay, so let me rephrase your question here or restate what you're saying. Right now, my recommendation is go for as high a premium as you can, possibly 110, 120, and then sell when the premium has decayed by around 70 cents, which means that you'd be selling somewhere around, between 50 and 80 cents. With me on that so far?
Mm-hmm.
And the reason for that is the volatility index, the VIX, currently is at 22, but over the last couple of months, we've been hovering around 25 to 35. So high VIX, the translation is when you have high VIX, you have high premium.
Okay.
But as the VIX comes down, the VIX, remember, is a fear index. As it comes down, it means that you can no longer get that $1.20 premium like we were getting a couple of weeks ago.
I see.
So now, once that has, because that has adjusted, it means that if you're going to get $1.20 in premium, you're very, very close to the money.
Mm-hmm.
We don't want to be close to the money. Instead, we want to be as far away as we can from the money. So the thesis here then is that if you get your 70, 80 cents premium, then you can decide to come out at about 10 or 20 cents, which is, for a long time, that is what we have done.
Okay.
Yeah.
Thank you.
Yep. Oh, Mr. Bell, thank you, man. Thank you. Mr. Bell says he's invited about 4 or 5 people to join us. Thank you so much for the kudos on that. And you're most welcome. That's my mission that's my goal, to help as many people as I can. as many people as I can. So he is saying, Mr. Eddie, I've invited 4 or 5 people to join us. We are all considering joining your course sometime in the near future. You're very helpful. Man, that's a blessing. That's a blessing. Thank you. And Stella agrees and Deborah agrees. So, oh, Mary started the 5 reasons, huh? Let's see these. It's cool. Very cool. I'm honored. All right. So yeah, this spread is going beautifully. It's at 85 cents at the moment. And it's now 10:06. Basically, for a spread, I don't expect to be in a spread no more than an hour. If I'm still in the spread for about an hour, something's not going very well. So I have a tendency to also, and that's also part of my plan, is that if I'm in a credit spread, I don't want to spend more than 45 minutes to an hour on that. So with this spread currently being at 77 something dollars, notice that I'm up about $112. I might decide to just take profit, even though I have a good idea, I have a good feeling that this is going to drop down somewhere and we're going to take profit. But if you wanted to take your profit, all you have to do is just adjust this take profit from 50 cents to maybe 75 or 70 cents. And you can pick that up. So if we put in an order here for 70 cents, then it means we make 30 cents out of this. We end up making what, about $150, give or take. In fact, let me demonstrate how to do that. I'm going to change my take profit from 50 cents to 70 cents. This is a part of teaching. So, oh, what did I just do? Yeah, there we go. So I'm going to adjust these from 50 cents, make that 0.70, and let's see what happens. And I'm going to send. Remember, the leg that I changed was my take profit, right? My stop loss is still $2. And remember, I can also modify my stop loss, right? So that's a beautiful thing about a debit bracket order. I don't think I've shown this before. So let's see. Mary guides. He stays beside students. Nice. Oh, wow. Yeah. Wow. Mary, I'm about to cry. No, I'm not going to thank you later. I'm going to thank you right now. Right now, Mary. Thank you. Thank you very much. So what Mary is saying is that, can we see his blush? There we go. There we go, Dora. Yeah, we should, right? Yeah, my class, and by the way, the next class is starting next week, December 7th. So there's still a few spots left. And if it fills up, we're just going to create another one at a different time. So don't feel shy. But December 7th, I think that's going to be the last class for this year before we start planning for 2023. 2023, obviously, there's a lot going on. We've got a $100,000 challenge. You need to talk to me directly to figure out what that is. It's for people who are committed to making $100,000 or more in their account. That is over and above what they pay themselves every week. Is it possible? The answer is yes. Resoundingly, yes. Have we seen it before? Again, yes. Can you do it? Of course you can. Anybody can do it. So that's for 2023. That program has already started. I've got a few people in the program that I've taken under my wings, and we're going to do that. So if you're interested in that, first you need to be in the class. Then we'll figure out you're a good fit for that program. If the answer is yes, we go full swing. Again, it's about your future, right? I know I can do it. If I can help enough people do it, the better. So for next week class, it's going to be a very, very accelerated. You still get all the material within a shorter amount of time. It's going to be twice a week instead of once a week. That's just because of the holidays, right? We don't want to make these. There's plenty of holidays over December, so we want to make sure that we can help you. And do you know how to get a hold of me? We put in the website here. It's options with Eddie.com. There we go. Yeah, all sorts of ways. There we go. We just sold at 60. We just bought at 60. We're out. You see that? We're just talking, and all of a sudden we locked in $200. That spiked down. That spike down just happened. We didn't learn anything today. Hopefully we learned something, but we now know that one, a bracket order is very powerful. If you forget to put in a bracket order, you can always put it in after the fact. And I showed you how to do that. Right? So that trade is complete. I'm pretty sure that this is, going to trend downwards, but do we care? What do you think? Is $200 good? Is $200 in about from 9:32 to 10:11? It's about 40 minutes, 45 minutes. I think that's about I think it's better, right? It's good. So thank you, Claude, for giving us that topic of the day. Let's see. Faye wants to know, do I have morning classes to accommodate people who work in the afternoons? That answer is no. I don't have. The only morning class that I have is on Thursday, Power Morning, which is not really a class per se. Instead, what it is it's a trading room that we all join in, and it's available to all alumni of Options with Eddie. And basically, you're watching me trade. We're watching each other trade. We call them out. We dissect what happened overnight. We basically break it down. We plan our day of what we're going to do that day. And the good thing is we have no idea what the day is going to bring. We just have some ideas of what happened overnight and how that is going to guide us. But you get to see the thought process, especially if you've never traded before. I think it's very, very important. So all my students are welcome to do that. I encourage it highly because it's part of the learning process where you think on your feet, basically, right? And it's easy to say, oh, you should have done this, you should have done this. Hindsight is 20/20. That's what we say, right? But it's a whole lot different. It's a different ball game when we are all on this together. Market is open and your heart is in your mouth. You're just pumping. The minute you push that trade, we don't know what's going to happen. And we've seen good results. We've seen, some not so good results. But the important thing is we understand how to get into it. We don't always make money, but we do show you how to do that. On average, I think every time we meet on Thursday, we're averaging about 10 to 15K around the students live. Right? So you get to see that, you get to do that, and you don't have to trade live. Right? In fact, I encourage, if you don't know what you're doing, if you don't understand the concept, don't do it. Just watch or do things in your sim, watch the video, wait for class or, for us to get to that section. And then that ought to help. But I think it's very powerful. That is becoming one of the most popular things, I think, ever since we started. We didn't used to have it, but now we've got, I don't remember how many we've done, but people look forward to it. People change their schedules just for that. So I'm going to continue doing it. Okay, why was your thesis that the market would go down on that day? I would have guessed it would go up and fill the gap. Jackie, which day are we talking about? Are we talking about this day that we just finished over here, the one that we just traded? This?
Yes.
I'm not really sure, but first off, I was doing an example here based on, because I don't remember exactly how things played out that day, but you could also see that this was a week. I noticed I only stayed at the 15-minute. I didn't even go to the 1 minute. Did you ever notice that? This is the first time I'm going to the 1 minute chart. I rarely come down here, except early in the morning, because this is a very deceiving chart. this chart will make you do stuff you wouldn't do on a regular basis. So I always stay on the 15. More calmness, more stable. But to your question is, do I think that I'm not really sure. Remember, we did look at ES here, and at the beginning of the day, it was minus 30 something, 34, 35, right? Yep, it was negative 30, 33. So when we picked a point well above. First and foremost, it was above the gap. So I was not worried. I could have taken out my stop, but I rarely take out my stop. But the idea that, we have, I think these on-demand ATR probably is not updated, but I'm not really sure. But there are more things, Jackie, that we would look at to decide where to go with a spread.
Okay, thank you.
Sure. Mm-hmm. I don't think, Jackie, we've talked about spreads yet in your class, have we?
We discussed debit spreads, not credit spreads.
Not credit. Yeah, we'll talk about credit spreads in deeper detail. So, does the support and resistance levels break down to the buyers and sellers level? So, support and resistance is also synonymous to buyers and sellers level, if that's the question. In order to find good entrance along with the gap, in order to find good entrance. So I think it's a yes to all those questions. The gap is very, very significant when you are deciding where to place your spread. It is super, super significant. Is that such a word? I think I just created a word. But the answer here is yes, because when you're deciding where to place your spread in terms of credit spread, if you're going to do a PCS a CCS, it needs to be above this point, above 4026. It needs to be above that. Okay. If you're going to do a PCS, it might be a bad idea because we have a downtrending day, right? We have a downtrending day. I don't think on demand is not available on this particular date. So you wouldn't want to do a PCS. Let's recap some of these rules. How do you decide when to do a PCS or when to do a CCS? You do a PCS or put a credit spread when price is going to be trending upwards. So remember, the PCS is bullish. It's a put credit spread. If we gapped upwards, then you would want to be below the gap. So puts credit spread is a bullish strategy when market is going up. Call credit spread is for when the price is trending downwards or we gapped down, then that's a good day to do a call credit spread. You want to be above the gap either way, as far away as you can get, still capturing a little bit of, as much premium as you can. So those are the rules. If price is trending downwards, we do a call credit spread. If price is trending upwards, we do a put credit spread. Okay. Direct message. Okay. Let's talk about this one offline. The person who sent me a DM. Let's talk about that one offline. How about that? All right. Any other questions? No? Cool. Well, it's approaching the top of the hour here, 12 minutes. So we can switch subjects. I think we've been talking about credit spreads. Marlon is asking which ones do I prefer, options or futures? I think I'm a daytime person, so probably options. Futures, I guess you can do futures 24/7, 24/6 rather. But I think that for me, I've been doing options a long time. I'm starting to do futures. I'm also going to be teaching futures. But I've had better results with options. Yeah, had better results with options. Futures tend to be a bit more expensive. The requirements are a little tighter. You have to have a margin account. You have to have certain minimums. The commissions are out of this world. Thinkorswim charges $5 per position. So I'm constantly adjusting my position to make sure that, well, first and foremost, make the commission back, right? So if I'm going with ES, maybe I'm looking for $2.25 in premium. That will cover about $100. Yeah. So if you can get, Jackie says TradeStation is cheaper for futures. That's great. If you can get approval on TradeStation, how much is it, Jackie? How much they charge? Opening and closing, round trip. Dollars, but $1, really? Huh. Okay. $2 round trip. And they have a 50% deal right now on TradeStation. 50% on what? What do you look for? Consider if you want to identify market trend first thing in the morning in brief. There's plenty. Still, I'm going to have to disagree on this one. In the last 2 hours of the day, you don't want to be trading. So what Stella is saying here is that spreads are preferable to buy PCS, to do PCS, CCS in the last 2 hours. She has had more wins when she was trading spreads the last few hours, even though there was less credit. So you have less credit, I agree, but you also have significantly less time to recover if things are not going well. So you have a strategy. If it's working, by all means, you do it. And by the way, just on a commentary on that note is that there are thousands, little or even hundreds of strategies that we can all make money. And then we can't say that there's one that's better than the other if it's working for someone. So it's just personal preference. If it's working for you, then that's good, and you know how to work for it. Manage it and risk manage it. That's great. So cool. All right, 8 more minutes. Who's got the final question here? None. Okay.
Eddie, on Thinkorswim, when you're doing these credit spreads, what's the cost? Do you have to cover the your possible max loss on that? Your account, as far as your account size.
What is the cost? Is that what you said?
Right. Like the cost of the actual trade. And
okay.
What do they require?
Got it. So for a 5-point spread, you need the value of the spread in margin. So in your account, if you want to sell one spread that's 5-point wide, you need at least $500 in your account. So that's number one, right? So if you're going to do 5, like we did in this example, you would need at least $2,500. It's simply 500 times 5, right? As far as the cost, there are 4 legs. Now we know that TOS charges, I think, about $2.50 on a round trip. So it would cost you roughly $5 per spread, right? I'm getting kind of tired here sitting down. I'm gonna stand up. Got this new standing table that helps me out. There we go. Been sitting for too long. Nice. There we go.
$5.
$5 spread, right?
What's it? 250. What's a round trip?
I think around, it might be 250 or something like. It depends on what your relationship is with Thinkorswim.
Yeah,
I've
think
been
it's
with them
around
long
260.
enough. 260 for a round trip. Okay. So yeah, it's not $5. Yeah, that would be too much. It's about 260, 250. I have a deal with them. I've been with them for a very long time. So I'm paying, they've reduced my commissions steadily over time. And unfortunately, you have to ask them in order for you to get it. They don't just give it to you. So every year, every few months, I call them up and say, hey, I'm giving you all this business, look and see how much commission I paid you guys. Can you give me a break? And usually they say yes. So yeah. All right, cool. All right, guys. It's 12:55. I think that we have to get out of here. If there are any other questions, you guys know how to get a hold of me. Options with Eddie. There's plenty of ways to do that, or you can hit me on Facebook or on YouTube or any social media. Just Google me, you'll find me. Sounds good?
Thanks, Eddie, for another great session.
Hey, thank you. I enjoy it. Stop share here.
Everybody have a Merry Christmas, Eddie, you and your family.
Hey, I forgot to say that. Merry Christmas. Merry Christmas. Awesome. Cool. All right, guys.
Thanks, Eddie.
Adios. Thanks, Masha.
Blessings
Bye-bye.
to you all.
All right. Bye-bye.
Bye.